Okay, everyone, here's going to be the second part of week 2. And here we're covering chapter 17. We're kind of skipping ahead, but it's kind of related to like what we've done in the past. Some of this is kind of like just a rehash of what we just talked about. I'm going to try to like cover the main points on this. I'll kind of skip some of it. I'll kind of cover the main points and then kind of give you some little hints on your homework to help with that, like you have to do on Mind Tap. So your homework is for this week, it comes from this chapter 17, and it'll be, through the Mind Tap. All right, so here we're looking at the nature of capital expenditures. So, these capital outlays that you make, they're going to have, have a long-term impact on what products you can produce, what markets you can go into, where the plants are located, and what kind of technologies that you use. All right, it's important, to do careful analysis of this, because once you make these capital investments, you're kind of stuck with them. It's kind of hard to reverse and change them. Yeah. So capital expenditure, well, what's the point of this? Well, you're spending this cash outlay, you're doing it to generate, future revenue streams. Okay. And so with these, it's like you're thinking of it over a long period of time. Like in your homework, it's going to be one of the questions is over a 10-year period. Okay. And so your capital budgeting, this is, the process of planning for this and evaluating the capital expenditure, whether you want to do this project or not. How do you want to fund it? Do you want to fund it through, internally, like through your earnings, or like issue new stocks and bonds to raise money for it? There's many different things you got to take into account. No, it's not. There we go. So one thing to keep in mind, and this is what will be demonstrated on the next graph, is when you're raising capital, you don't just think about it as a whole. You want to think about it, marginally. That is like, all right, how much is this next capital going to cost us? Like, what's the marginal cost of this? So you don't think about, what's capital as a whole, because like, depending on how much you've raised and how much more you need to get, like it's, it could change, on the margin here. All right, so what I'm talking about, we'll look at like a project that has potential, A through I here. These are all potential investments. And this shows like, your rate of return, how much you're going to earn from it. Right. As you can see, like obviously A is going to earn the most. You want to do that one. B, not quite as much. C, D, E, F, G, H, and I. Right. These returns on these investments, these expenditures here are going to keep decreasing. All right. And you got to think about these on the margin. So you make these, that's kind of self-explanatory, right? You make these investments, you only think about each individual one, not all of them as a whole. And with okay, all right, let's do all these projects. Is it profitable, like to do all of them? Well, you don't need to think about that way. You got to think of them each individual. It's the same way when you think about your cost of capital, right? So it's going to be easier at first to raise it, and so your rate of return, cost of it's going to be a little bit. Your rate of return, your cost of capital is going to be a little bit lower here at first. Then you see it rises as you keep having to raise more of it, and it keeps getting higher and higher. And this is the way you got to think about this. You got to think about it on the margin. All right. So if you're wanting to do investment C, you got to look at, well, what's the rate of return from C, all right, and what's the cost of capital here? Like this, you got to think about this next amount of capital that you're going to raise to do that. All right. You want to ignore this lower cost here. You don't want to average out what it's going to be. You want to think about like what this next amount of capital that you're raising. Right. The same way with E here. You don't look at the cost of capital for one it was for C. You want to think about how much does it cost through here. Right. And that's what it's talking about. You got to, when you're doing the economic thinking, you think things on the margin. That's how you do it rationally. All right. Let's see. So the capital budgeting process, we've kind of covered that. This is kind of just a rehash of what we talked about. Like these steps that we take. Now, in a minute, we'll talk about another type besides net present value to determine, okay, well, do I want to do this project or not? Is it profitable? But so here's some basic guidelines that you follow. First cash flow should be measured on an incremental basis. And so one thing you want to do here is, like, you want to, these cash flows each year, you want to measure them separately. And that's what you'll do in your homework problem. There'll be a problem where there's 10 years of cash flows coming in. All right. And so you want to discount them and look at them on an incremental basis. Another thing you want to do is you have to think of it on an after-tax basis when you're trying to determine it. Right? When you're looking at it versus the cost of capital, you want to make sure you take out your taxes. Right? Pay whatever your firm's marginal tax rate is for each period. Right? Because this is going to give you a clear indication whether it's profitable or not. Also, you want to consider these indirect effects of the project here, like in the problem that you'll be given in Mind Tap. You're going to depreciate your project. So you want to consider that when you're determining your after-tax after-tax income as well, because you want to depreciate it, so that'll save you some on taxes and lower your pre-tax income. All right, now fourth here. Now this isn't in your problems here, but sunk cost is something you got to consider. That is something that you're going to pay regardless of whether you take this on this new investment or you stay open or close or just anything like that with sunk costs. Like, so good examples, like say you got a restaurant and like you're in a 2-year lease. Well, these lease payments, you got to pay whether or not you stay open or not, or like, if you expand it or whatever, if you hire more employees, you try to cook more, you're paying that regardless. That shouldn't go into your business decision. All right. It should have no impact whatsoever, because those are sunk costs. You ignore those. All right, also, this is something you got to keep in mind too. Like, you have other options with capital to do something with it. So you can't just look and say, oh, this is profitable, I want to do it. The economic profit actually may be negative. Like, there could be something else that you could do this for. And so this opportunity cost is greater than what you're doing it. And so it could, be a negative profit. You want to make sure you're putting your capital towards what's going to give you the highest return. You want to consider all these, the other potential things that you can do. Right? So that's where you take into account opportunity costs. All right, let's see. All right, so I mentioned there's another way, like, to kind of say yay or nay whether this is going to be profitable or not. We've talked a lot about the net present value, where you discount future streams of money and compare it to this initial cost. And if it's positive, okay, then it's worth it. If it's negative, then you definitely don't want to do it. Another way to do it is with this internal rate of return. Okay, so there's one of your problems in your book uses this. And what this is like where you determine the discount rate, where if that's the discount rate and you use that with your income streams, it's going to be equal to this initial cost for the investment. All right, it's going to equal out. So for instance, if you determine that at a 5% discount rate, it's going to be equal to the investment, that is, the profit would be 0. Well, if the cost of capital is higher than that, you wouldn't want to do it. Like if it's 8% cost of capital, that's not going to be worth it. You would need the cost of capital to be below 5 for it to be profitable. Now, both of these, they're going to give you the same thing, whether it's profitable or not. They're just kind of two different ways to do things. Okay. Let's see. Oh, went the wrong way. There we go. This is just kind of going, through the net present value that we've talked about. 2. Remember, when you're looking at your cost of capital, you want to look at your pre-tax cost. That is, you want to take away your depreciation. Use that, and then it'll help determine what you have to pay taxes on. So make sure you're doing that when you're trying to define what the rate of return that is required by the investors. Let's see, 23. Okay, as far as ways to raise capital for the firm, one of these options is you use your internal equity. That is money that the company's earning that you have left over after your cost. That's one way to finance new investments or one way to raise capital, and as you're using your own money. The other is external, like where you're issuing new shares here. And one thing where you want to consider when you're doing this external, where you're issuing new shares to raise money, is you want to take into consideration these, flotation costs. This is something, these can be fairly large. You want to also take those into account when you're issuing new shares like to your company to raise money. And another thing to consider here is, you may not get the selling price for these. It may be discounted some when you're first selling them here. Okay. So this is something you want to consider as well. Okay. Go the right way. All right. Okay, so the weighted cost of capital. So yeah, when you have these different ways to raise capital, you want to make sure you weight them properly when you're determining your overall cost. And another thing to remember also is the fact you want to look at the marginal cost of capital. That is like the next amount of capital. You look at it on the margin. You make these decisions on the margin when you're doing this. This is one thing you want to consider. Okay. So another thing you want to keep in mind is kind of straightforward with private firms. Now you have other things you want to keep it, consider as well. But like as far as like whether it's it's easier, you have an easier objective. Exactly what you do. That is, you want to earn a profit. Okay. You have some other constraints you have to deal with, but like it's kind of simple to do that. But when you're looking at the public or not profit, like you have some other things to keep in mind. And so here's where you'll have a problem in your mind tab where like, you look at obviously the net present value, like which one would be the best due to like the cost and the savings it's going to give you. But it also considers some other things. Like it considers like how many lives are saved. You really can't. It's kind of hard to do that with putting a number on that. So like sometimes when you're doing these public goods, like your cost benefit analysis, it's going to be a little bit different. You may have different goals other than just profit. So it's a little bit more difficult. And so it's something you want to consider. There's a problem in your mind tab that kind of covers over this. And gives a good example of what we're talking about. Let's see, let's go ahead here. I don't want to go too much of this. This is kind of going over the, firms that are either public or not for profit. 31. Okay, now we did mention, just because like your net present value, or if it exceeds your hurdle rate or your internal rate of return, if just because it's like it's going to be profitable to do it, there may be something else that holds it up and keeps it from taking place. There's other things you need to keep in mind that could do that. There's some sort of physical constraint. Legal constraints obviously are a big deal. There could be something going on with that. There could be something going on politically. There may be some sort of social and religious constraints to keep in mind. And just all sorts of other things to keep in mind that could keep the project from going place. That's not, the end be all of like a decision taking place, being made on something, whether it, clears, like if it has a positive net present value, or if the internal rate of return is greater than like the cost of the raising capital. There's other things that could keep a project from going on. Even if you say, this is the best way to do this, this has the highest return, it's a positive profit, this is the best thing, it still may not take place due to these other constraints that a firm has to deal with. Right. Let's see. Let's just skip ahead to 36 and let's talk about this example, and then I'll kind of like talk for a minute about, give some hints on your homework. All right, so this is kind of a good example explaining like the role of an economist. Like it's pretty good example here. So in 1992, a junior geologist was preparing a bid recommendation for an oil tract in the Gulf of Mexico. All right, so she worked for this oil company, OVI, Oil Ventures International, and she's kind of an analyst. and she was trying to determine like what what would it be worth bidding on this tract of land here. Okay, and so this tract that they're looking at was next to one that they use, and so they realized that they have some productive wells that are close to that, so there's probably a good chance these will be too as well. But there's no really other competitors that are kind of around this tract like them, so they kind of have some insider knowledge that it's worth their while to go ahead and make a bid on this and to get it. All right. And since no other competitors know about this, she's taking that into account. She's like, okay, we may not have to bid exactly what it's worth here, and we can still get it because nobody really has this knowledge that we do, that there's some tracts right next to it that have some profitable wells. Okay, and so she took this into account, and she said like a bid of $5 million will be good. So this is kind of a cheap bid, but like nobody else really knows about this. Like this should be more than enough to ensure that they're able to be able to bid and win on these tracts of land. But for whatever reason, OVI's their management kind of ignored these recommendations, and they submitted a bid of $21 million. So a lot more than what she suggested. But they won it over the next highest bid of $750,000. So there's a huge difference here. Like they paid a lot more than what they needed to. Okay. So if the board of directors ask you to review the bid procedures of OVI, how would you proceed? All right. So this is kind of like where economists come into play, where they can they can do this quantitative analysis, kind of what she did, but also try to as economists, you also want to kind of understand people's behavior. That is, they're going to act rationally, but like the thing is, they're going to have different self-interest here. All right. So they're going to act, rationally, optimally, and they're going to act in their own self-interest. So they may have different interest here. They may have different goals here. All right. So this could explain why these managers and this analysts acted so differently here. All right. So that's one thing as an economist that you can do here. So you can kind of see this, why they would act the way they did. And so, okay, what can we set up? How can we change the way we go about doing this to make sure that everybody's incentives align here? We want to make sure everybody's self-interest is in the same thing here. That is, getting this bid here as cheap as we can. Right? Now, this is where maybe some of y'all's background, there's a couple of people that run it, that look like they're managers. They may have some input here. I don't really see anybody that's a quantitative analysis, but I'm just guessing here, like maybe what happened. Maybe these managers had some incentive where it's really important that they get this. And so, they didn't want to take any chance. So they just bid like a ridiculous amount here, 21 million. Or maybe they just completely ignored her. Like, well, maybe they do. I don't know. Maybe they knew something we didn't. I don't know. I'm not really sure. This is something that we could talk about in class that could be interesting. Maybe I'll have some input on this, on why these, their incentives are not aligned as well. Right. And this brings, this is that problem from the first week, the principal agent problem. Okay. But, the principal or the owners, a lot of times their incentives or what they want to do, their goals are not aligned with what the manager's doing. The manager may have different, different self-interest. Maybe they're not aligned like in what they want to do here. Okay, so this is kind of example. It's not the owner and the manager, but like, it's still the manager. There's someone else who may have different, goals here. All right. So with her, like maybe she's not worried about this off chance that it doesn't get it. So she's doing it as kind of looking at it as kind of rationally as she could, like, taking consideration, but maybe she's not worried about this like weird one-off where maybe somebody bids like a really high amount, like it doesn't make any sense. Whereas the manager's like, really, we want to make sure we get this. Maybe, it's some sort of, if they do get this tract of land, like it'll help, help their bonus or something. I don't know. I'm not really sure. That's really the only thing that could describe that such a big discrepancy. Either that, I just didn't really trust what she said, or maybe somebody else gave him some other recommendation. I'm not sure. Yeah, That is interesting. But like I said, this is kind of like what's neat about economics. Like you have this quantitative side where you're looking at things with objective numbers, but you also you want to try to evaluate the psychology of each individual, because they're acting in their own self-interest. And so you want to try to, create some sort of system or create rules where the incentives of every actor are the same. All right. So everything's aligned, and like I'm